So we're looking ahead to 2026, and it looks like the global financial system is heading for a major crossroads. We've got two incredibly powerful forces on a collision course: the crazy explosive growth of AI and a massive shift in global trade policy. Today, we're going to break down what this collision could mean for all of us based on a new Bank of America report. All right, let's dive right in. And to really set the stage, just look at this warning from that report. History's clock is ticking. Wow. That tells you right away we're not just talking about some minor market dip. The analysis suggests we're at a fundamental turning point where major economic cycles are all converging at once, putting some serious pressure on the whole system. At the heart of this whole thing are those two massive, conflicting forces that are pretty much set to define the year. On one side, you have the absolutely exhilarating but, let's be honest, uncertain world of artificial intelligence. And on the other, a huge tectonic shift in global trade. Let's break down each one, and we'll start with AI. Okay, so the first big conflict is all about the future of the AI industry. I mean, is this incredible growth we're seeing the engine of a whole new economy, or are we just watching a massive bubble get bigger and bigger, ready to pop? The data is pointing in two totally different directions. Now, this is where it gets really interesting, because this slide just captures that contradiction perfectly. On the left, you see the engine of growth, right? Massive amounts of money are pouring in. NVIDIA, for example, is dropping $2 billion into its partner CoreWeave, and it's having real-world effects, with companies like Nike saying automation is a reason for layoffs. But on the right, you see the seeds of doubt. There's a chip crunch that's expected to last through 2027, which is going to drive up costs. And that brings up the risk of what economists call a pig cycle, basically where huge overinvestment leads to a glut in the market and then a collapse. So, which one is it, boom or bubble? Well, the report actually uses a data model to figure out the probability. And this really shows you how uncertain things are. There's a 45% chance that the AI optimism just keeps on going, fueled by a stable chip supply and real productivity improvements. But the model gives a slightly higher probability, 55%, to the bubble scenario. That's where a low return on all that investment, plus more government regulation, could lead to a really big drop in semiconductor stocks. It's basically a coin toss, with the odds just slightly tilted toward a downturn. Okay, let's move on to that second major force and see how it all starts to build. We're talking about the huge impact of U.S. trade policy under President Trump. The analysis points to this as a primary source of global economic uncertainty for 2026. And to understand the scale of this, you just have to look at this number: 100%. President Trump has threatened a potential 100% tariff on all goods from Canada. A move like that would send just massive shockwaves through the North American supply chains, especially in things like energy and agriculture. And it's not just threats. For South Korea, a key U.S. ally, the administration has already announced a concrete tariff hike from 15% up to 25% on major exports. This is a direct shot, framed as a response to delays in trade agreement approvals over in Korea. This slide breaks it down even more. You've got the 100% threat against Canada. Then for South Korea, that 25% tariff specifically hits things like cars, pharmaceuticals, and lumber, which would be a direct blow to companies like Hyundai and Kia. And then for China, the pressure is a bit more surgical. You have states like Texas banning Chinese hardware and software, which hits the sales for giants like Alibaba, Temu, and Shein. You can see how these policies aren't just abstract ideas, they hit real companies and the markets they operate in. So you've got these two massive forces, the AI uncertainty and this tariff storm, colliding. The big question is, how are global markets going to react? Let's take a look at the forecast for the major economic blocs. For the USA, the outlook is pretty much volatility, driven by all the political fighting over budgets. But the report does see some potential strength in strategic areas like rare earth minerals. Over in the EU and the UK, they're expecting more stagnation, mostly tied to Germany's slowdown, though a potential trade deal with India could be a bright spot. And for China and Hong Kong, all this geopolitical friction is expected to hit their tech sectors hard, which could mean less trading volume in Hong Kong. For anyone invested in these regions, it suggests a time for caution, for sure. Now, the report points out a really fascinating situation brewing in the South Korean market. It's described as a paradox, a battle between two powerful opposing forces. Let's dig into what those are. So on one side, you have an absolutely incredible amount of domestic money. Net assets in Korean investment funds have skyrocketed past 1,376 trillion won. That's the highest growth they've seen in 18 years. So the key takeaway here is there is a massive wave of local cash that's ready to prop up the market. And this slide just shows that tug of war perfectly. You've got this powerful tailwind from all that strong domestic investment, which is providing a pretty solid floor for the market. But at the same time, there's a huge storm gathering on the horizon, that 25% US tariff, which is a direct threat to South Korea's export-heavy economy that could weaken the Korean won and kick off a slump, creating a really precarious balance. All that instability is reflected right here in the currency forecasts. The analysis predicts that if the US and Japan step in together, they could strengthen the Japanese yen. But for the Korean won, that tariff risk is expected to push it weaker, maybe towards the 1450 to 1500 mark against the dollar. And these kinds of currency shifts may have major ripple effects on everything from the cost of goods to your returns on international investments. So in this kind of environment, with all this uncertainty in both tech and trade, where do investors go? The report brings up a key concept from Austrian economics: hard money. Basically, this refers to assets that hold their value over time because their worth comes from their physical properties, not from a government promise. Think of something like gold. And we're already seeing this flight to safety happen in a big way. Gold has surged to a historic high of over $5,000 an ounce. But what's really telling is that even people from the crypto world are hedging their bets. The stablecoin issuer Tether, for example, has reportedly bought 27 metric tons of gold. That signals a really broad desire for tangible, hard assets when times get uncertain. So how do you navigate all this chaos? The report doesn't end with specific investment advice, but it does give us a framework, a set of core principles for thinking about the year ahead. Here are the 3 principles it lays out. First, in the AI space, focus on quality. Prioritize companies that can show real productivity gains, not just the ones building out infrastructure. Second, maintain a strategic position in hard assets like gold to hedge against the instability of fiat currencies. And third, manage volatility. That means prioritizing defensive risk management, especially in those sectors that are right in the crosshairs of geopolitical events, like these tariffs. And that brings us to the final question, really. The analysis makes it crystal clear that 2026 is shaping up to be a year of intense change and disruption. This convergence of tech uncertainty and geopolitical friction, it's creating a storm. And as this storm arrives, the key question for everyone is whether they see it as a crisis to be afraid of or an opportunity to be seized.